There's a big reason why you should never day trade or actively trade in the crypto world. And that's because there are 3 types of traders that will always kick your butt and take your money in this wild, wild west that is the unregulated world of cryptocurrency. So if you're curious to learn about these types of traders and what all techniques they use, then all you have to do is just keep on watching. Hi everyone, my name is Kevin from Bitcoin for Beginners, here to bring you interesting and informative content without any fluff or frills in this bear market. So while you're watching this video, if you find it informative at all, then you can support us by smashing that like button and subscribing down below if you haven't already. Okay, so let's get started. So this video is another one in our content partnership with HODL. Originally, it was done by Anthony Shedd, the founder of HODL. I will include the link to the original article down in the description below, so you should definitely check that out and check them out as well. So the crypto world is the wild, wild west. We all know this. It's unregulated. What is illegal in the stock markets can still be done in the crypto world without any repercussions. People don't have to play fair, right? And they can profit at your expense. So if you're doing worse than the market is doing, then someone else is doing better. It's simple math. Now, there are 3 main types of traders that are doing better than you. In this video, we're going to take a look. First one is insider traders, right? When people trade with non-public info. This is legal in almost all traditional markets, but research says that they're able to consistently beat the market with this insider info. Some famous examples include the Bitcoin cash pump prior to their Coinbase announcement, Korean financial services regulators trading prior to restriction announcements, and more. No one is really surprised at this anymore, particularly in the crypto world. Some examples is this Bitcoin Cash on Coinbase. Look at that pump in this chart. And even on Reddit, someone joked that they knew Bitcoin Cash is coming in a few days and that they have a friend at Coinbase which told them early. This is obviously insider trading, and there was investigations done into this potential leak. And some other examples was the Steam listing on Binance that came out, but a huge pump that happened beforehand. And someone on Twitter wrote, how did everyone know that this was going to be listed? Another one was announcement on Binance for PivX, an insider pump that begins 20 minutes earlier. And finally, another one of Trig skyrocketing 30% 5 hours prior to the tweet from Binance that it was going to get listed. Seems like insider trading, a lot of examples of this. And just a snapshot of all the comments on Reddit. People aren't surprised anymore. I'm not surprised anymore, and you shouldn't be either. Next up is whales. These are investors with enough capital to manipulate markets on their own. There's been many research papers done on Bitcoin price manipulation from large actors. For example, the Tether and other ones a few years ago. And if you wanted to look up these researchers, they're from UT Austin, University of Tulsa, Tel Aviv University, and other ones. So let's take a look at 4 major price manipulation techniques that can be done by whales. First is stop loss hunting. Let's take a look at an example for coin XYZ. You put a market sell order of 1,000 coin XYZs, which drops the price from 150 to 110. Pretty big drop. Investors naturally start to panic sell, and you watch stop losses go off at around $100. So the price drops even more when these auto stop losses get triggered. And then you scoop up all the stop loss orders at $90 and below, and then you just sit there, wait for the market to recover before repeating the process at a higher price. This works best on coins with less liquidity and smaller order books. Number 2 is short or long hunting. This exchanges can do to wreck margin traders. They have the capability and incentive to do so, because the traders get liquidated if the price moves in the wrong directions just a tiny bit, and they still have to pay the big fees if they get liquidated. So the exchanges can particularly use bots to trigger these price movements that cause massive liquidations. So here's just an example that Anthony made, in which, let's say someone enters a long position at $10,000 for Bitcoin, leverage at 100x. So the margin is 1% at $100, and the bankruptcy price is at $9,900. But you do have a maintenance margin though of 50, so the liquidation price is $9,950, just a little bit below your long entry price at 100x leverage. So here is an example of the charts, and you can see the big drop on the right hand side, followed by a huge spike in volume where there wasn't much volume going on beforehand. This is very, very likely to be done by bots going margin hunting. There's even a Twitter account dedicated to this called BitMEX which tracks the BitMEX liquidation bots, and it shows all the longs or shorts getting liquidated and at what price points. Next up, spoofing. This is when large whales submit orders into order books but plan to cancel them before they are filled. This is usually illegal in traditional markets. The goal is to send false signals to investors, right? Example, you place a large buy order below smaller buy orders, which sends a bullish signal. After a few trades are filled, the spoofer cancels the rest of the large buy orders. But price already starts to rise due to the bullish signal, and then the spoofer can sell their coins for a profit. This you can also do in the opposite direction if you want to send a bearish signal and buy coins at a discount. Like you can see in these order books, these huge buy walls or huge sell walls, depending on which direction you want to go. And once the price goes near them, they just disappear instantly. Finally, wash trading by whales. And this is when you buy and sell your own order to create false signals. It makes it look like there's more volume, which is a bullish indicator, of course. And also, it's easy to manipulate prices on coins with smaller order books this way. But it's hard to prove because it looks like real trades going on. Bitfinex was hit by wash trading during their Bitcoin Cash fork because of the rules they put in place. I'm not going to go too far into detail on this event, but you can take a look in the link I put from Anthony's original article that goes further into detail on this. And number 3 type of trader taking your lunch money is the pump and dump group leaders. Pump and dump is when you buy a lot of a cheap coin, inflate the price, and then dump it at a higher price. A lot of signals or pump telegram groups do this. How it works, the leaders find a coin that's easy to manipulate and shill. They buy the coin slowly and quietly. Then they tell their inner circle that pays to be in that inner circle about the coin early on, who then buy the coin as well. These people then start shilling the coin to public signals pump groups, and the prices rise, the group leaders sell the coins to their profit, and then they tell their inner circle to start selling, and then the price starts falling, and the people who get into the game late, like you and I, the normal people, lose. Only the group leaders consistently win at this game. And so you can see one of these signal strategy groups, XVC, new website release, new now mooning, buy it now, buy it now. That's what they do over and over again. And even Crypto Medicated, this person unveiled that a big group was involved in shilling these coins and pump and dump by posting screenshots of their Telegram group talking about manipulating coins, working with miners, working with exchanges, and shilling it to all their Twitter followers. So all these 3 traders doing foul play, taking all of our money, what can we do about this? Well, basically we can stop trying to time the market, stop actively trading, just index the market and HODL perhaps. Because Anthony writes that indices have been proven to beat 95% of professional traders in equity markets over a 15-year period. So a total market index can guarantee that your performance matches market performance, whereas actively trading cannot. After all, in the crypto world, we're not protected by regulatory bodies like the SEC, so we will have to deal with all of these various shady techniques going on. So in the crypto world, we have freedom and rapid innovation on one hand, but we also have foul play equating to fair play on the other hand. So that's it, guys. Thank you for watching. Let me know what you think about this episode. And also thank you once again to HODLbot and Anthony Shih for the content and research. Once again, if you find this informative at all, please smash the like button, subscribe down below if you haven't already. This is Kevin. I hope you have an amazing rest of your day, and I'll catch you guys next time.